Hello, this is Will Allen with Centera Capital. In today's market update, we are going to continue our look at the housing market, something we started in our last video, and also on the back of last week's update from the Congressional Budget Office that the U.S. government is on track for a nearly $2 trillion budget deficit this year. We're going to tell you why that is not a good thing. Let's get into it. All right, now before I get into the market update, just a reminder to like and subscribe to the page or share with any friends or family that you have who may not get market updates from their financial advisor. All right, so last video that we had, we talked about the housing market. We did an in-depth look and we looked at the fact that home prices are basically at all-time highs. They are much more expensive than they were 3 or 4 years ago. And when you combine that with the fact that interest rates are also much higher, near 7% for a fixed 30-year mortgage versus 3% 4 or 5 years ago, it basically means that buying versus renting is much more expensive than it has been historically, and so a lot of people are looking at renting. We also mentioned the fact that there have been a construction of a lot of multifamily units, a lot of apartment buildings over the last couple years, and so what that's done is that meant rents have gone down some over the last couple of years, and that's been a positive for those looking to rent. It's made it cheaper versus buying. Today we want to kind of go in a little more detail because we've gotten some housing numbers in the last couple of weeks that we wanted to share with you. The first thing that we're going to talk about is existing family sales that took place. So we've talked about the fact that because mortgage rates are high, a lot of people, when mortgage rates were at 2.5%, 3.5%, they locked in those rates. They're just not willing to sell their house now and give up that low mortgage. So there's not a lot of existing homes for sale. We see that when we look at the number of existing homes that have recently sold. So let's put that up there. And you will notice that last month we got homes at a 4.1 million annualized clip. And if you look going back to 2014, this is much lower than the range of 5 to 6 million that we saw during that period. And so that just means, again, there's not a lot of existing homes available. Inventory is very low. By the way, I should mention, if you are someone who are wanting to move, what this means is now's a good time to sell if you have another property that you know that you can get in. Because a lot of people find themselves in a position where they go to sell their house and then they're stuck because they can't find another house they want to buy. So that's just something as an aside, if you're thinking about selling, you want to think about before you start that process. But that was the first thing, 4.1 million homes annualized that sold. All right, the second chart that we want to put up there is looking at U.S. building permits and housing starts. This is something that you will notice both of these have declined a lot over the last year or two, and this is not what we want to see. We want to see a lot more building permits and a lot more housing starts because those are eventually homes that are going to be finished, and that's more inventory where people can go and buy, but you're seeing that go down. That is not good for prices because we'd like more supply means lower prices in the future, so that's not good. And then as far as housing activity and the impact on the economy, we've mentioned that a very important indicator is total spending on construction and total employees in the construction industry. If you go back 50 years, pretty much every single recession that has taken place, prior to it, there was a rollover in construction spending and employees, a lot of layoffs in that industry, and then eventually a recession happened. We've looked at this data in videos over the last year a couple different times, and we've seen that spending and the number of employees in the industry are both basically right near all-time highs. We have not seen that rolling over. But if housing starts and building permits continue to go down, eventually you may see a rollover in those two categories, and we don't want to see that. So that's a very important point that we wanted to bring to your attention. The last chart under the housing heading that we want to discuss is something called the Affordability Index. And this basically just looks at how much it costs to buy a home, and when you factor in where mortgage rates are, what's it going to cost somebody to go out and buy a house and to pay their mortgage. And we'll put that chart up because this index goes back into 1990, and you'll see that it's at 95.9 right now. It's been down near this range a couple times in the last few years, but prior to that, you can see that's basically an all-time low if you go back to 1990 when this chart started. So again, that just tells you that if someone is wanting to go out and buy a house, right now the Affordability Index is saying this is one of the worst times if you're trying to buy since 1990, really, is what that is saying. We want to see that stop declining. We want to see that go higher because that's going to mean houses are more affordable and it's a better time to buy. So again, when we take a look at housing, it's important to note again that in the last couple of years, we've seen new home constructions pick up because not a lot of people are selling their homes when they have 3% mortgages, for example. And so it's been good to see builders building more, but based on the recent data with building permits and housing starts, that's declining. That's not the trend we want to see. We're going to be monitoring this very closely in the months to come. All right, for our second point, we are going to talk about last week's report from the Congressional Budget Office. They are a nonpartisan kind of watchdog, and they basically keep track of the numbers of the federal government and their spending. And last week, we got the news that for the 2024 fiscal year, which fiscal year is basically, instead of a calendar year, the fiscal year started October 1st, 2023 through September 30th of this year, 2024, and taking a look at what the government's doing in that 1 year period. And what we found out was that for this year, that the U.S. government is now on track to have a budget deficit, meaning how much money, much more money are they spending than what they are bringing in with tax revenue. And what we found out is that number went up from an estimate in February of $1.5 trillion to nearly $2 trillion. That is a massive increase in just a few months. The biggest component of that was student loan forgiveness that has taken place over the last couple of months. That was the biggest component, but there were other things in there as well of additional spending. Now, one way that this is looked at is as a percent of the budget deficit as a percent of the U.S. Economy, GDP. And we got a chart there that looks at this going back to 1950, the government surplus or deficit. You can see there in the 60s, 70s, early 80s that the government deficit was very small. It was 1%, 2% of GDP. And then from 1980 through basically 2009, it was kind of jumping around. But I want to really focus on the last 15 years because you can see that we've had a deficit for that whole period, and the most recent deficit, 6.3%. By the way, you can see that really went down near to 15% when COVID hit because we had nearly $10 trillion of spending by the government in the first 2 years, and that was both a Republican and Democrat in office during that stretch. And that's a key point, by the way. And I'll throw a chart up real quickly of total government debt. You see we're up to almost $34 trillion in government debt, and that's happened with both a couple Republicans and a couple Democrats in office. And despite whoever's in office, there's just so much spending over and beyond what the government's bringing in, and so the debt load is really, really going up. But coming back to the percentage, we have an issue here in that the markets have shown in the last year that they are now more sensitive to all of this government spending. And the fact that the federal government is now projected to be almost a $2 trillion deficit in this year, that's a problem. And let's look at what they're projecting over the next 10 years. So we have a chart here and there's a lot happening. So what I want to illustrate here in this chart to you is two things. We are looking at outlays, which is spending, and revenues in the darker blue. At the lower level, the lower blue number, that is the amount of revenues as a size of the economy, the GDP. And you can see that the average, going back to the 70s, 17.3%. And that's basically where we are right now. So the amount of revenue, the amount of tax revenue coming in is kind of right where it has been historically. But if you look at the spending, we're up at 24% right now, where the average spending has been at 21%. You can see we are well above the average line, and the projections over the next 10 years by the Congressional Budget Office is for spending to continue to be well above the historical number, whereas the revenue is coming in higher than its average. So what that tells you is right now we have a government spending problem, not a revenue problem, when you're looking at what is coming in as far as tax dollars. Again, this has been a bipartisan problem over the last 20 years especially. So, but it's something that's going to be important over the next year. We have a presidential election in November. Whoever wins, this is going to be in something that they are going to have to deal with because the market's made it clear it's becoming more of a problem. And if somebody asks, well, what's an example of that? Let me give you the example. Last year on July 31st, the stock market was basically at an all-time high, and the Treasury Department came out and said they were going to be issuing over $1 trillion in Treasury bonds in the third quarter. That was much, much higher than what they historically issue, and they were having to do that because spending was so much more than what the revenue they were bringing in. When that happened, interest rates on longer-term U.S. Treasuries exploded higher. They went from 3.95% on a 10-year Treasury bond to over 5%. That meant that mortgage rates went straight up, and that's how we got mortgage rates of almost 8% in October of last year as a result of that. And that was the market responding to all that issuance of Treasury bonds and all that issuance of debt, saying, okay, we demand higher interest rates in return for buying this debt because we know you have so much to sell. So right now, the 10-year Treasury is at about 4.25%. But if that starts to creep up, that's the market saying, hey, there's just too much spending taking place. So that's going to be important for us to monitor with regards to your portfolios. Now, before I get into my recap, just one note that last year when the Treasury Department came out with their announcement of over $1 trillion in bond issuance for the third quarter, interest rates started to go higher. We had client portfolios in very conservative positions on the bond side. Why was that good? Long-term U.S. Treasury bonds, as measured by the TLT ETF, 20-year plus Treasury bonds, dropped over 20% in a month and a half's period. We had no exposure to that in any client portfolios. And that's an example of what we try to bring to the table for our clients' protection when markets go down. All right, just to recap what we talked about earlier in the video. On the housing side, there is not a lot of activity taking place right now because there's not many existing homes for sale with mortgage rates so high. And that's something that we're going to be watching because housing starts and building permits have gone down a lot over the last 6 months to a 1 year. And we don't want to see housing activity start to roll over and where people in the construction industry start losing their jobs. That has been a pretty good recession indicator over the last 50 years. On the U.S. government spending side, we have to watch this because, again, this impacts interest rates, which impacts bond portfolios and stocks as well. And the news we got last week from the Congressional Budget Office that the government's on track to spend almost $2 trillion over and beyond what they're bringing in, that was not something that we wanted to see. And no matter who wins the election this year, they're going to have a major job on their hands trying to get our government finances back in good order. Okay, thank you so much for watching that video. Listen, only 30% of those watching the video are subscribed to the channel, so if you haven't before, make sure you do subscribe. That way you do not miss any videos in the future. And if you are new to CeteraCapital.com, if you haven't seen a video before, go to the website, CeteraCapital.com. You can go to the contact page, reach out, and we'll have a phone call and set up. We have a 3-meeting process to see if each other feels it is a good fit. Thanks for watching and take care.